Good morning, and if you're watching this much later on in the day, then good day to you. Settle in. I am so excited because today we get to have something that you love doing as well, Devon, an educational conversation about passive investments with real estate.
Yep.
Let me introduce myself first. My name is Varsha Pasel. I am a team partner and realtor here at Forest Hill Keystone, and welcome to Keystone headquarters. With me today is Devon Fleck. Devon, would you please introduce yourself?
Yeah, for sure. My name's Devon. I'm a senior associate at Equiton Capital. It's great to be here. And Varsha, thanks very much for hosting it.
Oh my goodness, I'm so excited to have you here, Devon, because, and just so we know, you're looking up at the camera up there, not at the
okay,
computer.
Great. Noted.
It's okay. Devon, for me, it's always been assisting those either looking to invest because they want to be landlords, right? Or perhaps they've house hacked and they're renting out their basement or a separate unit in their home, right? This conversation is so exciting because it's new to me as well. There comes a time where not everybody wants to be an active landlord, which is where this conversation is really going to be valuable. So could you lead us into a little bit about Equiton and who you are?
Yeah, sure. I'll talk a little bit about, who Equiton is and essentially how we do this. Equiton is what you would call a private equity real estate firm. Now, the term private equity, I feel, is a misunderstood concept. Essentially, what we do is we pool together investor capital and we go out and we acquire various real estate assets. It might be apartment buildings, it could be land parcels to do a development on. Very important to note that we utilize various different channels when we raise capital. So one of the things that we do is we can reach out to institutions and we'll raise capital from pensions, perhaps university endowments. We also work with financial advisors, family offices, multifamily offices. And what I work with specifically is retail individuals, people like me and you who want to get exposure to real estate. They want to passively be involved in real estate and diversify their portfolio a little bit. Let's
break that down just a little bit, if you will, because it's a lot of, for people that are in the industry, the terms probably make a lot of sense. But correct me if I'm wrong, it seems like the threshold to get into private equity or, that kind of raising capital, venture capital, all those terms to me, somehow I'm thinking of corporations. I'm thinking of giant institutions or large pension funds, to invest, things like that. When you say retail, you're talking about everyday consumers that now have access?
That's right. And it varies. I mean, in terms of getting access to private equity, it's really accessible to all. One of the primary purposes of Equiton is to allow everybody to get access to institutional grade real estate, no matter your level of sophistication, no matter your financial situation. It's really an entry point into real estate. Just to put it in perspective here, I work with high net worth individuals, both different rental properties. Maybe they own their primary residence. They're looking for a complement to their existing portfolio, right? Maybe they don't want to be a landlord anymore. One of the things that we say is being a landlord on a good day is a part-time job. On a normal day, it's a full-time job.
Oh my gosh.
So this is really a way to get access to the real estate that they love through an institution or through a private equity firm like Equiton. On the other hand, the other day I had a conversation with a university student, brand new to the space, has never invested in real estate, just wants to understand how these investments work, also wants an entry point into institutional grade real estate. And it's great because you have that access way. You don't need the large down payment. You don't need to deal with fluctuating interest rates. It's as easy to get into some of these investments with as little as $5,000.
And that is the title of this entire webinar, right? That's what kind of got us in. And I'll say that almost seems impossible in our minds because, like I said, we're always assisting clients as, that end user, even though they may not use it for an investment sake, they become the landlords, right? When you say you're a private investment firm as opposed to publicly funded, correct? Could you break that down a little bit for some clarity?
Very common question. What is the difference between public investments or private investments? And again, I feel as if the private world or the term private has this allure, this mystique to it.
Absolutely,
it's mysterious. People aren't familiar with it.
Exclusive entry. That's what I hear.
Exactly, and it's really simple when you break it down. the main differences between a private investment and a public investment. And most people are familiar with the term public REIT, or publicly traded stock.
Yes. Okay. Break down REIT as well. We're going to
so we'll get into that, but let's
Yeah,
rewind a little bit here, and I'll explain the differences between publics and privates.
Yeah.
A public investment is one that trades on an exchange. TSX, S&P 500, NASDAQ. People are very familiar with these spaces. Private investments do not trade on an exchange. So what's the benefit? Why would you want to be in private investments? Well, the main benefit is going to be greater consistency and lower volatility. You see, one of the things that happens with public investments, and this is very common, is you see the markets moving up and down. This is what we call volatility. Another question I get very often is, why is there public market volatility? Why are we seeing that up and down movement? At the end of the day, it really comes down to emotions or rationalities. When people are excited, for example, at the beginning of COVID, we're sort of midway through 2020, entering 2021, interest rates were at zero. Money was very cheap. People had a lot of free time on their hand, right? They were working from home. They saw the markets rising and they wanted to be involved in that. So they tend to buy. And that sends the overall market higher, as well as specific stocks. However, on the adverse, it can go the other way. When there's a little bit more uncertainty, you have political turmoil, military conflicts breaking out, interest rates moving up, people panic a little bit. They start to see a dip or a downswing in the market. And their rationality is, well, I don't want to take a loss on what I've worked to earn, right? I've spent the last 2 years earning. I don't want to take a loss in the dip. So they end up selling the investment. That puts negative pressure on the market. And that's where you start to see the yo-yo effect. Private investments are uncorrelated to public market investments. That is the main difference. We do not move up and down with the same public market volatility. So the end result is going to be greater consistency on a month-to-month basis and a year-to-year basis.
So I'm so glad you touched on factors other than the interest rate, because for a very long time, especially when it comes to residential real estate, most immediately the conversation is always interest rates. But there's huge things at play here. Like you mentioned, the war, inflation, gas prices, all of these have an immediate effect on what's happening in our real estate market. You mentioned that the risk, I would say, would you say there's lower risk in private investments as opposed to public?
Yeah, so it's not necessarily about the risk. It's about acting as a complement or an alternative. One of the things that I get asked a lot is, if private investments are so consistent on a month-to-month basis, and I had a friend say this the other day to me, is why don't I just move my entire portfolio into the private space? That's not necessarily what you want to do. The way that I look at it is, it acts as a defensive portion of your portfolio. And you see pensions do this a lot. Pensions are starting to enter into the private space as a way to diversify and as a way to get a little bit more consistency. So it's not necessarily about what's more risky and what's less risky. It's about spreading out the risk, right? Not necessarily putting all your eggs in one basket, but having it in various different places.
Yeah, I completely agree with that. I think it's important, even if, the conversation happens with those looking to buy their first rental property, it's okay, that's great. How many would you like under your belt? And after that, what else are you going to do to diversify your investments?
Exactly.
Right? Let's make sure that we're not putting all our eggs in one basket. Let's touch on raising capital.
Yes, very good question.
You mentioned raising capital. That to me sounds very startup world, So could you break down what that looks like for us retail consumers in the private equity world? What does that mean?
Yeah, sure. And that really speaks to the how do we do it. So one of the things that we do is we raise capital as a firm, and we go out and we acquire various real estate assets. Generally, the capital is coming from 3 different channels. And this is what I alluded to earlier, is you're going to have institutional funds, pensions, endowments, family offices, etc. And you're also going to have retail investors. And retail investors, they have multiple different ways in terms of how they want to invest. They can use registered accounts like an RSP, TFSA, LIRA, or they can do it directly outside of a registered account into Equiton. We pool that capital together and we go out and deploy it. Now, it varies depending on the investor. Everyone has different outcomes, different desires. So we're trying to determine, is this someone that's looking for a more conservative investment, maybe with some cash flow? Are they looking for a more growth-oriented investment? All out returns, the highest returns possible. So we try to offer various different tools or various different outlets for people to get involved in.
And you mentioned that you've been helping university students, correct?
Yes, I've spoken to university students. I've spoken to high net worth individuals.
Correct. So that just the threshold to get in. What would you say is your bare minimum to get in, and what kind of growth can someone expect with this kind of private equity investment in real estate?
Yeah. And that's one of the main benefits is physical real estate ownership, especially in a country like Canada, is becoming increasingly more difficult. Yeah. Right. And we were talking about this earlier. Oh. Large down payment requirements, $150,000, $200,000 just for a down payment. Yeah. Financing.
And now it's even become drive till you qualify, right? So a lot of people are unable to even invest in the place that really feeds their lifestyle, and who wants to commute
exactly.
on a daily basis?
So the barriers to entry are increasing.
Yeah.
That curtain's starting to rise a little bit.
Yeah.
Now, individuals can get involved with our strategies with as little as $5,000 for our income and development fund. For any development that we do, it starts at $25,000. So it's a very approachable way to get exposure to passive real estate.
Fabulous. And how does someone say, let's walk through the journey of a user, right? I say, okay, Devon, I'm ready to invest. What does that journey of a consumer look like?
Great question. Yeah. It always starts with the education. That is the most important thing. Ultimately, what our job is to be educators.
Yeah.
I generally start the conversation trying to get a better understanding of what the individual is looking for. Everybody has different desires depending on your age. Some people approaching retirement, they're looking for passive cash flow, right?
Right.
Maybe a little bit more of a conservative investment. Some of the younger clients that I have, they're looking for growth-oriented investments. So we're trying to get a better understanding of their risk tolerance, better understanding of their time horizon, how long do they want to be invested for, as well as their end outcome, what kind of returns they want.
Right.
So we'll take them through the strategies, we'll get a better understanding of their desires, and we'll try to pinpoint or we'll try to match a specific strategy with that outcome that they want. Now, from that point on, we would have a little bit of a questionnaire. We want to have a better understanding of their suitability. Private markets is a heavily regulated industry. And one of the things that we have to do as a fiduciary for our clients, as a registered dealing representative, is I want to ensure that every client I bring on is suitable to do an investment. So it would just be a quick questionnaire. And once that person is invested, it's really just about maintaining the relationship. One of the things I like about the private markets in general is it's a very personal relationship. Every single client I have, they know they can contact me directly, whether it's a phone call, text, email, I'm always available if they have any questions. It's very different from what most people are used to, right?
If you're
with a financial institution, sometimes you might have to sit on hold for 20 minutes just to be transferred over to someone who you've never met before. It's not the case here. It's very personal.
And I think that's lost sometimes in the sort of speed to want to invest and let's just get ahead. This is, as much as it can be transactional, because look, we have to put this transaction together. The relationship is key because these are your life investments. What is, you want to be in trusted hands when it comes to something like this, as small as your entry might be, the growth and making sure you're taken care of. If something's happening in the market and you have a question, you want to be able to reach your representative, right?
Exactly. And we want to be fully involved throughout the journey, throughout the course of that individual. And circumstances change, right?
Yeah,
Sometimes
absolutely.
maybe something pops up and they're now looking for more of a growth-oriented investment. How can we properly direct them and educate them on our new developments? Right. It's an ever-changing landscape. Is really how I look at it.
Would you agree that real estate is just one way of using your funds as an investment, right? Like it's just putting it towards real estate is just one avenue for you to invest. Having said that, could we touch on REITs, the real estate?
Yeah, let's talk about REITs for a little bit.
Yeah.
And REITs is a real estate investment trust.
Right.
90% of people I talk to are familiar with public REITs. These are the REITs that you can purchase on any form of a stock exchange, really. At the end of the day, what we do is really the same, except it's a private REIT. And this goes back to what I said earlier. We do not trade on an exchange. The benefit of a REIT is it's going to give you diversified exposure. So it's going to give you access to not just one single property or one single rental unit. It's going to give you access to a plethora of different properties, right? An assortment of different assets within that fund. The second thing is the REITs that we have, at least, are cash flowing investments. So they issue monthly distributions. This is beneficial if you're someone who's in retirement and you're looking for that monthly cash flow. Maybe you need some extra cash to supplement your retirement lifestyle. And then finally, REITs give you a little bit more flexibility. It's far easier to buy and sell into a fund compared to buy and sell a residence worth $2 million, for example.
Right. Okay, so what kind would you say are the styles of investments at Equiton? Right?
Yeah, another really good question. We really have two different styles.
Yeah.
So it's sort of bifurcated into two here. We have our funds on one hand, and we do developments on the other hand. Now, funds and what you would call REITs are diversified, they're cash flowing investments, and they also provide liquidity, right? So it gives you that ability to buy and sell. A development, on the other hand, is much different. Developments are usually going to be concentrated investments into a specific condo building or the construction of a condo building in the case of what we're doing. For that reason, the holding period is much longer, right? In the case of the development that we have right now, it's a 5-year holding period. So you as an investor, you have to be comfortable holding that investment for at least 5 years.
Right.
The second thing is the development projects are non-cash flowing. Of course, it's an investment into the construction of a building. So there's not necessarily income that's going to be generated from that investment.
Right.
The final thing is that the developments are going to be concentrated investments. It's going to be an investment directly into the construction of a single building. So you're not really getting the same kind of diversity that you would get in a fund. Now, why would you want to go for a development investment?
Yeah, what does that return look like?
Yes.
Yeah.
It is by far the most lucrative form of passive real estate investing. The developments that we do target anywhere from 16 to 20% net per year.
Wow. And here we are selling pre-construction, saying, here you go, you've got VIP entry to these units, but really getting into the development space is also very lucrative.
Yes.
Right? You're really getting immediate access by investing with the development. Now, you mentioned that there's a holding period of 5 years when it comes to development.
Yeah, so it varies depending on the development.
Project, okay.
It varies project by project. We've done some where the holding period's about 3.2 years. We're doing some that are around 5.2. And there's certain developments that are even longer term. Maybe they're 7, maybe they're 10 years. But I would say to be, within the mark, it would be anywhere from 4 to 6 years.
Who would you say is your ideal client then for a development versus the funds? Because you mentioned cash flows for someone more so in that retirement phase, more immediate return versus the development.
Yeah. So a lot of people that I talk to that are looking for developments, they have to have a few, they have to tick certain boxes. They're growth-oriented individuals. They're okay taking a little bit more risk. They're looking for the higher returns. The second thing would be the time horizon. I mean, how long are they willing to be in an investment for? If you're a little bit younger, let's say you're in your 40s, 30s, your runway is significantly longer than someone who's in retirement. So you have the ability to be locked into a development investment and to reap the benefit of those returns. So it's case by case, but generally I would say it's someone who's got a little bit more of a long time horizon and as well as a comfortability with a concentrated and what I guess you could consider would be a slightly riskier investment.
I'm starting to pull kind of parallels from what you're saying with, stage of life versus kind of investment.
Right.
We try to do that as well in assisting clients actually capture properties, whether it's for their investments or long-term appreciation, right? When you invest in a property, sometimes it's cash flow, right? Sometimes it's long-term appreciation, right? Like those are the kinds of, and we're always placing the client depending on their stage of life and their tolerance into those properties. So I like that you're matching them up the same. We mentioned that, the threshold to get in, you can use things like your registered funds, TFSAs, people are generally investing in all of these different ways. So how do you capture some of that into a private equity fund?
Yeah, so a lot of people that I would talk to, in fact, I'd say a majority of my clients use registered accounts to invest in these private REITs. LIRAs, RSPs, TFSAs, really, we can accommodate them all. And they have distinctive advantages. Really, the primary advantage there is you're going to be able to shelter your returns from government taxation. The other thing is certain accounts are going to pair nicely with certain investments. So going back to what you mentioned is who would be suitable for a development investment. If you are in your 30s or 40s with an RSP, well, that's going to be a perfect complement to a development investment. And the reason why is RSPs are generally funds that you're not going to withdraw. You're going to keep it within the RSP until you hit a specific age where you can then start drawing from that RSP. So naturally, if you're going to hold the funds within that account, you can pair it nicely with a development project that's going to be liquid and it's going to be a little bit longer term. So the registered accounts bring a unique angle to the table. And it's very interesting trying to figure out which registered accounts fit nicely which investment, and et cetera, and so on.
Yeah, fabulous. Is there something that we haven't touched on very specifically? I feel like we've gone through this really fast, but I'm sure there will be follow-up questions, I'd say that it is such a unique conversation to have, especially coming from my background where I only deal with residential real estate and assisting people purchase properties, and that's it. Right? Like, I absolutely love this education just personally myself, because like we said, diversification is key, and using some of these registered funds in a really creative way to build that, because everybody's goal, the goal is always build wealth, build wealth. Well, how are we doing this? Is it just sitting somewhere? Is there a way to invest it in a more passive way? Because like you said, being a landlord is not for the faint of heart. It is definitely not. And I absolutely love that we were able to do this. Is there something that I didn't touch on today, Devon?
I think we went over most of it. And of course, if there are any follow-up questions, more than happy to have a call. What I would say is for anyone looking to get involved into private or passive real estate, there's a few different things I would recommend. First things first is you can always go to the website, check out the team, look at the leadership, check out some of the projects we've done in the past. My email should also be available, and I have a special function in my email signature where you can book a meeting directly. And as I mentioned, it always starts with the education. So it's always trying to better understand who the individual is, what exactly they're looking for, and to break down the investments for them so that they can better understand how these operate.
I will be sure to put all of the information on how you can get a hold of Devon. I'll absolutely put it towards the end of this. And I want to thank you for this. I think this is a fabulous time to talk about these things, because the ability to, like, the access to properties with these rising down payments and interest rates, and just even saving, right, with the way the inflation in the economy is, it's nice to have an option.
It's great to have an alternative. And I just want to thank you for having me today, Varsha.
Oh my gosh, you were fabulous, Devon.